Hey everyone, and welcome. Today's explainer is going to uncover what I honestly think is one of the most fascinating corporate mysteries hiding right in plain sight. We're going to break down the investment thesis for a seemingly ordinary, kind of boring Midwestern convenience store and see exactly how it transformed into a massive, hyper-profitable Wall Street compounding machine. To kick things off, let me challenge your current paradigm with a quick trivia question. Think you know the food industry. Okay, what is the fifth largest pizza chain in the United States? Take a second. You've got the heavy hitters, right? Domino's, Pizza Hut, Papa John's, Little Caesars, but who on earth holds that number 5 spot? I mean, holding that fifth place position is no joke. It means moving a staggering volume of dough, cheese, and pepperoni every single day across the country. We aren't talking about some niche regional player here. To be fifth in the entire American food landscape requires an absolute behemoth of an operation. Ready for the punchline? It's a gas station. Yep, specifically, Casey's General Stores. Now, if you live on the coasts, you might have never even heard of them, but if you're in Middle America, you know exactly who they are. They're actually the third largest convenience store retailer in the country, and this massive pizza operation, that's the secret identity that makes their entire business tick. Not just a gas station, the reality behind the pumps. Section 2, the small town moat, dominating rural America. So, the foundation of their brilliant strategy really starts with real estate. They go exactly where the heavy corporate competition refuses to go. The contrast here is just staggering. Take a major player like 7-Eleven. They place only about 28% of their stores in rural environments. Murphy USA pushes that to 65%. But Casey's, a massive 83% of their locations are in small, rural towns. Out of their roughly 2,600 stores, a huge share are sitting in towns with populations under 5,000. By targeting these tiny communities, Casey's is leveraging a really cool economic concept called efficient scale. Basically, in a town of maybe 3,000 people, the local demand is just big enough to support exactly one modern, profitable convenience store. If a second major competitor tries to build across the street, they end up splitting that limited demand, and it ruins the economics for the both of them. So, what happens? The competitor simply doesn't show up. It creates this quiet, boring, but incredibly durable economic moat for Casey's. They become the undisputed food and fuel hub for the whole community. Section 3. The high-margin pizza engine, where the real money is made. They've got this captive, loyal audience in these small towns, right? So how do they actually monetize it? Well, they pivot from the fuel pumps outside to the store inside. The economics here are just brilliant. Outside selling fuel, the margins are incredibly thin and super volatile. Fuel is literally just the bait to get your car into the lot. The real magic happens when you walk through the doors. Inside the store, specifically in that private label pizza division, Casey's boasts a massive 41 to 42% margin. The pizza is the true profit engine. And this model drives absolutely explosive results. Take a look at their Q3 of fiscal year 2026. Diluted earnings per share shot up about 50% to $3.49. Net income hit $130 million, up almost 49%, and EBITDA climbed over 27% to roughly $309 million. But here is the most crucial takeaway. Their store count only grew by about 1% during this entire period. They didn't do this by just slapping down new stores everywhere. This was driven by squeezing maximum profitability out of the footprint they already had. So how'd they squeeze out all that extra profit? A huge catalyst was a massive technological overhaul. Casey's partnered up with Deloitte Digital to completely modernize the customer experience. They launched a state-of-the-art app, revamped the website, and rolled out a highly sticky loyalty program. And this wasn't just a basic facelift. It successfully supercharged that inside growth engine, literally tripling their year-over-year digital growth rate. They managed to modernize a beloved local brand without losing that essential community feel. Section 4. Building a C-store empire, the M&A playbook. Okay, so we know the inside engine is highly profitable. Now let's talk growth strategy and how they replicate this across the country. You see, the U.S. convenience store market is incredibly fragmented. Roughly 60% of locations are still single-store, independent operators. Casey's takes full advantage of this with a ruthlessly disciplined capital allocation playbook. Step 1, they buy up those mom-and-pop chains. Step 2, they plug them directly into the Casey's supply chain and food system. Step 3, they hook them up to that newly digitized app we just talked about. And step 4, the margins naturally expand to meet Casey's sky-high standards. It's a machine. And lately, they're executing this playbook with incredible aggression, leading a geographic conquest straight into the Sun Belt. For decades, Casey's was strictly a Midwestern thing. Not anymore. Look at this run. August 2023, they grabbed 63 Minute Martin certified oil stores in Kentucky and Tennessee. By November, they pushed into Texas with 22 Lone Star locations. A month later, 11 Easy Go spots in Nebraska and Oklahoma. And then the big one, July 2024, they dropped over $1.1 billion to acquire nearly 200 CEFCO stores, plunging deep into Texas, Alabama, Mississippi, and Florida. They're proving this rural, pizza-driven model can absolutely travel across state lines. Management isn't taking their foot off the gas anytime soon either. CEO Darren Revelez made it clear recently, stating they are getting right back on track with their historic growth algorithm. They're targeting at least 120 stores for the year, and they're doing it through a really smart, balanced mix of ground-up new builds and highly strategic acquisitions. Section 5, a premium price tag, the Wall Street catch. So you've got this business with a durable moat, massive margins, and a highly repeatable expansion playbook. But there is a catch. Just let this number sink in for a second. $28 billion. That is the massive market capitalization Wall Street has currently assigned to this seemingly boring small-town convenience store. When a company executes this flawlessly, the market definitely notices, and they price the stock accordingly. Which brings us to the multiple. Casey's recently traded at around 42 times forward earnings. Think about that. For a retail and fuel business, that is an incredibly rich, demanding premium. It essentially means the stock is priced for absolute perfection. The market is paying top dollar for the compounding growth story. Nobody is treating this as some forgotten, cheap value play anymore. And this perfectly highlights a classic bear case dilemma. As value investors love to point out, a quality business bought at a demanding multiple can still be a mediocre investment if growth meanly meets expectations. Paying 42 times forward earnings means you're operating with virtually zero margin of safety. You are personally underwriting their continued double-digit EPS growth and their flawless execution down south. I mean, if their pizza doesn't sell in Texas the exact same way it sells in Iowa, or if that multiple just naturally contracts, investors have a really long way to fall, even with a great company. And we also have to impartially look at the biggest structural risk debated by analysts right now: electric vehicles. It's a real tug of war. The bears argue that as EV adoption inevitably rises, fewer people are going to need to pull over for gas, which means eroding the foot traffic that ultimately leads to those high-margin pizza sales. But the bulls counter that argument by pointing out Casey's specific rural footprint. They argue that being in these tiny towns acts as a natural shield, significantly delaying EV adoption compared to the coastal cities. It's a really fascinating debate over the company's long-term terminal value. Which leaves us with the ultimate investing dilemma, right? When you uncover a genuinely perfect business, a fifth-place pizza giant cleverly disguised as a small-town gas station, do you hold your nose and pay up for that quality? Or do you stay disciplined and wait for a margin of safety that honestly might never come? It's a tough question, and one you'll have to answer for yourself. Thanks so much for joining me on this explainer, and keep questioning what's really driving the businesses around you. Catch you next time.